Hello, my name is Tanaka. I hope this video is going to find you well. It's going to be an introduction to trading. Okay, so the first thing that I want to do is to thank you for trusting in me and putting your heart and money on me and giving some trust that maybe this guy is going to change the way you trade and maybe you have a successful trading career. But before that, one thing that I want to tell you is that for you to be a successful trader as a person, you need to have some commitment. Hard work works everywhere, just like in school, in sports. The person who trains more is likely to be much more successful than the person who does not train at all, provided that he has or she has the right training. So I'm going to give you the right training that you need. Okay, so let's get started. So trading, basically from the basics of what trading is, everyone might understand this. Okay, so trading is the buying and selling of commodities. So think of trading from any market. Okay, uh, let's say the commodity in this case is maize, gold, or anything, laptops. Okay, so what you do in trading is that you buy something and then you sell it. Okay, so for you to make profit trading, for you to profit as a trader, you only have two conditions or two options. The first option is to buy something at a low price and then sell it at a higher price. Okay, so this is what we call buy low, then you sell high. You buy something for $1. This cost you $1, and then you sell it for what? For $2. Then your profit now is $1. Or you have an option on this one. Let me say that I have something that I own. For example, my computer, this one I'm using to record. So I have a friend of mine who is telling me, hey, I need your computer for $500. Okay, so my computer now costs $500, but I also have another friend who is willing to sell to me the same computer at $100. So now I sold my computer at 500. Okay, then I bought back the same computer at what? At 100. So my profit in this is the profit which I sold it in the one I bought it. At the end I have my computer. Okay, the computer is there, but I sold the other computer at 500, then bought it back at 100. So these are the two options you have in trading. Okay, so basically in forex trading or currency trading or any form of trading, you have a chance to go with the market in either way. Okay, in any way the market is going, it does not matter whether the market is rising or it's falling. You can make money as long as you anticipate what is coming. So in the case of this, we're going on the forex market. I'm going to start on the forex market, but when we are going deeper in the strategy, the methodology that we're going to use to trade as a group, you can trade anything which you like, but it's much easier to start with the forex market. Okay, so the forex market, what it is only simply means foreign exchange market. As you can see, this is where foreign comes from, and this part is for exchange. So the foreign exchange market is one of the largest markets in the world, trading around 6 trillion every day in open float. So you can see that you are sitting on the biggest ton of cash. Okay, so this is where there's no other place where you can make more money than on the forex market, because you have 6 trillion. Okay, the other market is, they will come 240 billion, 20 billion. Those are smaller markets. So the question which will come is, what is forex trading? So someone might want to know, what is forex trading? Forex trading, basically it is the exchange of currencies. Okay, so you have one currency, you buy another currency, which means you are selling your own currency. Okay, so when you're doing foreign exchange or forex trading, you need to have two currency pairs. Always two currency pairs will be involved in this, not one. You will have two. Okay, so what will happen here is that one currency is quoted against the other. So for example, we have a euro currency being against the US dollar. So what it means is that when you have 1 euro, you have 1 euro in your hand, you get something like what, $2. Okay, so for every 1 euro you get $2. For every $2 you get 1 euro. Okay, so the example goes for this pound, this is yen, this is Australian dollar, this is United States dollar. Okay, so each country has its own currency. On the forex market, the currency pairs that are available are the ones of the, I would say, successful countries. Okay, the currencies from the poor countries are not available because the stability of their economies. Some of them are available on the interbank market, but on our trading platform, those will be hard to trade. We'll be mainly focusing on trading major pairs. Okay, so like I said before, you have two options in any market to make money. It's either you buy or you sell. The moment you buy something, someone has to sell it to you. Okay, I hope you understand that. The moment you sell something, someone has to buy it from you. So two people need to be involved in what, in a deal. So when you expect a rise, you buy. Okay, and when you expect a decline or a decrease, you sell. That is vice versa. So I want to buy something for $1 and sell it for $10. Why buy something for $5 and sell it for $1? That means you are having what, a loss in your statement. You are suffering a loss. Okay, next slide. So a continuation on the forex market is that the trade in forex occurs between two currencies, because one currency is being bought and another is being sold at the same time. So like the example I gave you at first, where I was talking about euro and US dollar, this is simple, guys. Okay, I want you to be in a position where you have 5 euros in your pocket. Okay, so you have 5 euros in your let's say 50. It's a good round figure. Okay, so you have 50 euros in your pocket and you want to go to United States. Okay, so in United States you can't use your euros, you can only use US dollars to buy. Okay, you can use them. Okay, but let's pretend we are in this situation. Okay, so in this situation, I have my 50 euros. I need the United States dollars to go back to USA to buy something. Okay, so for this 50 euro that I have, it will be worth something like what, 70 US dollars. Okay, so I exchanged my 50 euro and now I have 70 USD. I am now in United States. Okay, after you are in the United States, something happens and someone calls you back home. Okay, you still have the 70 what, the 70 United States dollars. Okay, so with the 70 United States dollars, you take your 70 United States dollars back to Europe. Okay, when you have your 70 United States dollars, you can't use them in Europe. You now have to change them back to euro. Okay, so what will happen is that during this time, maybe you've taken around a week or a day, I don't know, currencies will be what will be fluctuating. The price is fluctuating. So what will happen is that when you come back to Europe, the price will have changed at which the euro was pegged at. So for the 70 United States dollars which you had, you won't get 70. You won't get 50 euros, sorry. At this example, maybe you get what 60 euros. Okay. So what will happen is what has happened here is that at first you had 50 euro and now you had 60. So your money is gained. So your profit on this deal was what? Was $10. This is what has happened in this deal. So I want you to reevaluate this. I hope it's simple. You have your own money, you buy another currency, you buy another currency, sorry. Okay, so in this example, I buy the USD, I have 70 United States dollars, I keep them, I wait for the rate to change. Okay, after the rate fluctuates, and now my 70 United States dollar is now worth 60 euro. I have made a profit of 10. Okay, so the other example is that if the rate had changed going on a decline, okay, and I had ended up with what? With 40 euro in here. At the end, I had 40 euro. It means that I had a loss in the deal. Okay, so at first I had 50, I bought 70, I sold the 70, I now have 40. Okay, so my loss is what? Is $10. Okay, so in trading, we have some major pairs and some exotic pairs. Okay, so the major pairs are the main currencies from, I would say, the first world countries. I don't know if maybe you understand that the most successful countries. In this page, we have the euro, which is the first we have for Europe. Okay, I hope you understand that euro is for Europe. USD is the United States dollar. So like I said before, each currency pair is trading against each currency pair. So when we have euro USD as a currency pair, there is nothing called what? USD euro. This thing will not exist because we already have the euro pegged against the US dollar. Okay, so the currency pairs will be paid in only one way. There's no reverse of a currency pair. Something like you say card United States dollar, no, it will be United States dollar card. Once we have United States dollar Japanese yen, there's no Japanese yen United States dollar. I hope it's clear. I'm making myself clear on that. So we have so many currency pairs. Like I said, you have the pound, the British pound versus the United States dollar, the United States dollar versus the yen. These are major pairs that you are seeing. 1, 2, 3, 4, 5, 6. These are our major pairs. So we have odd for Australian dollar, USD United States, Euro, EUR. They are just shortening. Okay, then CHF is Swiss franc. This is the money from what? Switzerland. Okay, these are our currency pairs. We have tons of currency pairs, guys. Like I said, we have exotic pairs, the one that will include something like CHF JPY. Okay, we have CAD JPY. Those will be what? Will be our exotic pairs. Okay, so next slide. So on this slide, I wanna talk about the prices. Every currency pair will have two prices given to it, which is the bid and the ask price, the buying and the selling price. So the buying price, for me to buy a currency pair, I will always pay something higher. If you see this is $23.04, $23.02, the buying price is always higher than the selling price because I'm buying from a dealer. Okay, so every time I buy and try to sell immediately, I incur a loss. So we also have what is called a pip. So a pip is the fourth unit after a decimal point, which is the smallest unit of an exchange rate. So a pip, when I'm talking about a pip, this is the smallest unit of an exchange rate. In this case, it's 4. So if we change from 4 to what? To 5, the change is said to be 1 pip. If from here we have a decline to 0, the change is said to be what? 2 pip drop in price. I hope it's clear, simple to understand. So the fourth unit after a decimal point is a pip. Considering that your platform offers you 4 digits after the comma. If your platform offers you 5 digits after the comma, this is a fraction of a pip. Don't consider it. The fourth value still matters. Okay, so we have the difference between the buying and selling price. Okay, it's called spread. The difference between buying price and selling price is called spread. Okay, so to define spread, we'll say that spread is the difference between sell quote and buy quote in pips. So spread is always quoted in pips. So in this case, our spread was what? Was 2 pips, not 2 points. This oral points is supposed to be off because we said this is our pip value. So we are subtracting this number. We're subtracting this value from this one. Okay. We are subtracting this value, which is the selling price, from the buying price to get the spread. So our spread is now what? 2 pips. I hope you can understand how to read pips. A pip is the fourth decimal after the comma. If your platform is 5, leave the 5, it's a fraction of a pip. That's what is called a point. So what it means on spread is that the smaller the spread, the more liquid the currency is, the more money is on the currency. So you will see that on major pairs we have smaller spreads, but on exotic pairs we have what? Some higher spreads, because there is no more liquidity. So the dealers will be trying to make money off the spread on the people trading this. Okay, let me open the next slide. So on the next slide here, I'm going to define leverage. Okay, so what it simply means when you are saying leverage, let me read the definition for you. Leverage, which represents a margin ratio, enables a trader to borrow a certain amount of money that allows them to trade in much bigger deals. Okay, so with me leveraging my account, it's like a loan that I'm being given by a broker. Okay, so I'm allowed to trade with some money that I don't have in my account. This is both positive and negative impacts on my account. If I win, I make more money, but if I lose the smallest amount that I had very fast. Okay, so moreover, leverage allows one to trade using money than they have in their account. So if I have $10 in my account and I leverage my account, a leverage is just a ratio. Okay, so if I leverage my account, sum is 1:1, there is no leverage. 1:10, so you're getting a 1:10 leverage. 1:100, 1:1000, you are being given more money to trade. Okay, so therefore you leverage your account balance to place a bigger trade. Okay, so when you don't have money, you leverage your account, but don't over leverage your account because it's gonna cost you the money that you had. Okay, since currency rates move very slowly, this makes small trades unfashionable, as they only retain small profits and losses for every pip rate change. Like I said, the movements that occur in currency pair, they are measured in pips, which are small changes. That's why leverage is needed. Okay, so leveraging our account is trying to make more money off the smaller movement that occurs in what, in currency pairs. I hope you are getting it. Therefore, leveraging helps one to trade in larger deals, hence amplifying their potential profits and losses. Like I said, leverage is both positive and negative impacts. Don't over leverage your account. Okay, so on the part of leverage, you have to select the one that suits your account very well. So let's go back to define a pip. On that one, I defined it. So here's the definition of the pip. Okay, the full name for pip is called price interest point. Price interest point represents the smallest change in a currency pair. Okay, like I said, there is a fraction of a pip. We don't consider that. Let's leave it like that. The fifth decimal after the comma, if your platform offers you that. So typically it is the fourth decimal point. Okay, although many brokers quote using the fifth decimal. So be aware when you use the crosshair on your platform, it's going to show you something like 450 pips. When drag and use it, we'll do a lesson on MT4. It's going to show you something like 450 pips. It's only 45 pips. This value is a fraction of a pip. Don't consider it. However, the fifth decimal does not really affect the price, as it changes real quickly. So the currency pairs that include the United States dollar. Okay, a pip is 1 over 10,000 of a dollar, whereas when the currency pair includes the yen, a pair is 1 over 100 of a yen, because the yen is closer to the value of 1 over 100 of the other major currency. So almost a yen is almost 1:100. 1 USD is something like 140 yen, 120 yen. We are above the 100 mark. That's why you will see when you have a yen pair in your platform, it will only have 2 or 3 digits after the comma. So if this was euro yen, euro J P Y, this is euro Japanese yen. Okay, we're having the euro trading against the yen. This number would be something like 100. Okay, 0.320. What it means is that on any pair of a yen, which includes a yen, your broker is going to offer you a maximum of 3 digits, with this number being a fraction of a pip. Don't consider it. So from 4 we are going to 2, from 5 we are going to 3. I hope you understand that. In any yen pair, we don't have 4 digits after the comma. It's only 3 or 2 if they do not have what, a fraction of a pip. So this is what we call a pip, the smallest value change that is happening. So let's watch on the market watch what I was talking about. So we have the bid price and the ask price. The bid price being lower than the ask price. This platform, this is my platform. Okay, it offers me 5 numbers after the comma. As you can see, this is our comma: 1, 2, 3, 4, 5. This number is a fraction of a comma. This one, I don't consider it when I'm counting any changes in price. So if we have a change from 64 to 68. How many pips did price increase with? Okay, it's only 4 pips. Okay, so let's see the case where we are having a yen pair. This is euro yen. This is okay. As you can see on yen pairs, the value is closer to 100. Here we have 123, and we have what? 3 digits after the comma in here. So for us to measure pips in yen pairs, this is a fraction of a pip. We don't consider it. So if we have a change from 89 to 91, the change is what? 2 pips. The same comes here to CAD and odd JPY. It's around 75.359. Okay, this is a fraction of a pip. We don't consider it. Like in here, this is a fraction of a pip. Fraction of a pip. A pip is the second number after the comma, considering it's a yen, or if it's not a non-yen pair like odd New Zealand, this is our pip. Okay, so if the price changes from 75.35 to 75.30, the change is only 5 pips. We had a decrease of 5 pips. The fractional value which measures the points, the last fraction of a pip, don't mind about that number. Okay, it's important when you have so many contracts on your account, you see that the number will matter on your profits or loss. Okay, so let's talk about when one should trade forex. Okay, so the forex market is open 5 days a week, 24 hours. Okay, so from Sunday, late Sunday into late Friday, that's when the market is going to be open, depending on the part of the world which you are. So for me, basically, the time which yielded more profits was the London session and the New York session. Okay, we're going to talk more about the timings of the sessions. Don't worry about that. That is going to be on the next segment that I'm going to do. Okay, so don't worry about these times and the times that are out there, which they tend to say this is when the London session starts or the New York session starts. Some of them are wrong. Don't take that. I don't want you to be in a situation where you are coming in the market at the wrong time, because time is one of the most important aspects when you are trading. Okay, so for me, I'm most profitable during London session and New York session. In my country, this happens to be the daylight time. Okay, so the Asian session starts during the night and sleep during the Asian session. I don't trade the Asian session. So mainly we have 3 major trading sessions. Like I said before, we have the Asian session, which is the first session when the 24 hours of the day begins. We'll go into the London session, and finally the New York session, the day will start over again. So in 24 hours you have 3 sessions approximately. If you had to divide 24 with 3, each session will be approximately 8 hours. But it's not like that. I'll tell you more on the times and how does each time validate you, like how each time is important for you to be on your screen or not to be around. You don't have to be around your computer 24/7. It's not necessary. You need to know, okay man, the time is up, let me wake up and go to trade. Now I'm done my first 4 hours of the session, let me wait for the next session. We also have the times of when not to trade the forex market. So this is when you should not trade. Typical Asian session is the first. You can trade on the Asian session, but try not to. We also have bank holidays. If we have United States dollar bank holiday, what it simply means is that the United States dollar that day, there's not going to be much more movements. Okay, in the price. So when a price current pair is a bank holiday, leave the current pair and jump onto another pace. Also Friday afternoons, late Friday going towards the end of the trading week, don't trade. The weekends the market is closed, go and hang out with the friends, everyone you like, you do whatever you like. End of December, at the end of December, this is where some noise comes in. Going into Christmas, we have less volume in the market, everyone is celebrating Christmas. Don't trade during those times. We also have some news release, release of news events, okay, something like CPI data, inflation data, interest rates, non-farm payroll, NFP, a lot of news events will be around. You can see the news events at forexfactory.com. It will show you all the news events, forexfactory.com. This is where you can see the lineup of the daily market news event. So we have the market closing time. When the market is about to close, don't trade. The spread is too high, you get jammed out up. The market maker will open with a gap at the beginning of the next week, and then you'll be jammed. You can blow your account in a flash. During the night, which happens to be the Asian session in my country, times are different. Someone during the night is the London session, so this does not really matter if it says overnight, okay. So we have who the people or the who trades forex. So before you trade or before you go into any field, you want to know the players in that field, okay. So in this field of forex trading, we have some big banks trading forex. Barclays Bank, UBS, Morgan Stanley, JP Morgan, the Dutch Bank. A lot of big banks, they trade forex, okay. These are the guys controlling, moving around the contracts. So these guys typically they are in control. These are the first guys in the channel. We have some hedge funds coming. We have some big companies, Toyota, Amazon. They also affect the currency rate. And finally, we have the retail traders, that is me and you. These are the people who lose most money in forex trading, which means if you go and type in on Google the percentage of people who lose money in forex trading, is going to be something like 96%. If it did not change, okay. The number was 96% when I last checked. So what it means is that 96% of all traders lose money. And on that, it was said something like 70% of anyone who has traded will end up quitting trading because they have lost their money. The reason why most people lose their money is that they do not know the fundamentals of trading, and they don't understand what the market is really about, what makes the market move, and what is really going on in the market. So no one talks about the truth of the market unless you are lucky, like you found me early. If it's your first time trading, guys, I'd say this is like, it took me something like 2 years to really know about what is really going on the market, what really transpires, and what makes the market move. Finally met with a guy, he told me everything. I went back and validated it for myself. I was happy and I was like, hey, these guys are crazy guys. You will never see it. It's hard to find something you don't know, okay. And it's hard to find to see it if you don't know it. You don't know it even exists. How can you look for it? That's the case. So on my next slide, as I already said, the person who controls price in forex, price is 100% or 98% manipulated, okay. The only time that is not manipulated is that the person who is controlling it will allow you to do some certain things, but when you go to the extremes which it doesn't want, you will manipulate it. So you can call this the big banks, the dealer. I like to call it the market maker. This is the guy who creates each price chart which you see that is being traded anyway. It doesn't matter, it's forex, it's gold. The price of gold is being determined by the market maker. They will say that price is being controlled by the market forces. It's not like that. That's a lie. The market maker is in control. So I hope now you know that the market maker is the guy who controls price. You only duty now after will be to monitor his actions and trade in line with this guy. So examples of a market maker. As you can see, the room is too big. This is UBS, one of the biggest bank in Europe. They own about 12 or 8% of the total volume traded every day. So like I said, 6 trillion is being traded. Find it's 10% of 6 trillion. That's somewhere around 600 billion. I don't know, 60 billion. I don't know what the number exactly is. It's supposed to be 600, somewhere there. 12% of the amount that is being traded by these are professional traders. The only way to make money is for you to trade like these guys. These guys are the professional traders. Look at the room. It's something like a city hall, bigger than a city hall that I had been in. In my city where I live in, the city was something like half of this room. These are all professional traders. Never trade against these guys. Whenever you see yourself in a loss or in a winning trade, you know that you are trading against them or in line with them. So if you're making money, you are moving with them. If you are losing, you are doing the opposite. That is the truth of the trading market. Any market, doesn't matter, it's forex, it's commodities, it's stocks, it's equities, indices, crypto. Many of you maybe like Bitcoin, I don't know, but these are the guys in control. Okay, so you have to know who is in control first. How does he control it, and how can you join him after he controls the shit? So these are the things which the guys use to move the market. So these guys, they are not going to move the market at any time they want. They will move it steadily, slowly, but when they need to make some fast movements, okay, they will have to have some reasons backing them. These are the reasons used mainly with politics, public statements, change of officials, president coming in, going out, stability of governments, with economics, growth, domestic product, inflation, debt, sales amounts, interest from investors. You see that if a country is more debt, it's expected that the value of the country's currency pay is expected to lose, but sometimes you see it's increasing. And you also have central banks, finance circulation, interest rates, mandatory reserve funds. We have some natural disasters. This is what will happen. If an earthquake happens today in Japan, this guy, they have a target to go to $50. They will just move the price as soon as they hear about the earthquake, and then the whole blame is put on the earthquake. That is exactly what is happening. No one will tell you the truth, guys. I'm telling it to you, okay? These guys, they have so many reasons backed up which they can use. If someone is killed in the oil countries, the price of oil will fluctuate very fast, blaming that Trump has killed the person who was in control of the oil wells or something like that. They'll write tons of pages, okay? So for you to trade, what do you need to trade? Basically, the first thing that you need is a trading platform. Sorry, you need a trading platform. For me, I use MetaTrader 4, MT4, and MT5. MetaTrader has been my platform. So basically, if you are to trade with me, it will be easier to use MetaTrader 4. So every time you need to learn about a trading platform, go and learn on MetaTrader 4. You will need money. It's either it's virtual or real, and then you will need a broker, you will need device, then internet connection. These are the things that you need for you to trade. A broker is the guy who you are going to deposit your money, is going to link you with the what, the other side of the market, so that's in such a way that when you buy, someone is going to sell to you. When you sell, someone is going to buy it from you. So this is MetaTrader 4 platform. As you can see in here, we have a lot of things. This chart screenshot was taken from MetaTrader 4. This is Euro CHF, Euro Swiss. Okay, so this, as you can see here, M1, M5, these are time frames in here. So what it means on these time frames is that each bar or candlesticks will be created on each time frame. I did a video on MetaTrader 4. I'm going to attach that at the end of this video. So we have types of charts that we have on MetaTrader 4. We have a line chart. It's simply a line connecting closes of price after an interval of time. Okay, so if you are on in 15 minutes, after every 15 minutes there's going to be a closing price. At the end of 15 minutes, it's going to draw a line. This is a bar chart. It will show some bars. I don't use a bar chart. I only use a candlestick chart. This is the chart. Okay, this is a candlestick chart. As you can see, from here to here, price has been rising. So if you were with me from the beginning, for you to make money, you could have placed your buy in here and sold what in here. So this was your buy, sell. Your profit is all the difference between what the prices. So you buy low, you sell high. The reverse is true. You sell in here, you buy here. Okay, you sell, you buy in here, you have a profit. The problem is going to come when you think that, hey man, I'm selling in here, and then price rises, you end up what, buying in here. This is a mistake, which means that if say sold at a lower price and bought back at a higher price, you ended up with a loss. Never do that. Always sell when price is high and buy when what, when price is low. So this is what I was saying. When you think a currency will fall, you sell the currency. You are said to have opened a short position. Okay, if you think a currency will rise, you buy the currency, you open a long position. So in the forex market, you can sell or buy currencies. So when you sell, you are said to be bearish. When you buy, you are said to be bullish. These are terms used in the markets. They don't really matter. So for you to read candlesticks, like I said, we have a red candle that will be bearish, and we have a bearish trend. A bearish trend, price will be what, decreasing. As you can see, price is decreasing. In a bullish trend, price is increasing. In a bullish candlestick, price is increased. So in a bullish candle stick, this will be what, the open. Okay, then this will be the close. Okay, so price is opened at a lower price, closed higher. This is the high, this is the low. So within the interval, if this was an H1 candle, which means that the candlestick was formed within 1 hour from 9 to what, to 10. So when 9 o'clock started, this was the opening price. At 10 o'clock, this was the closing price. So we have the green body. But between 9 and 10, price reached the extremes, which were the high and what, the low. Okay, these were the high and the low. That is on what I have to say on candlesticks. Okay, So a bearish candlestick, we have an open, close, low and high R. So price is decreased, as you can see, represented by what? The down arrow. We have a bullish candlestick, is what? Is the opposite. A bullish candlestick, we have an open, we have a close, we have a high, we have a low. So if it was a 1 minute candle, when that minute started, this is the opening price, this is the closing price, this is the high, this is what? The low. So candlesticks are formed due to movement of price within a period of time. So for example, we have 1 minute candle, 5 minutes, 15 minutes. Some have some 30 seconds candles. They differ from platform to platform. This is what is offered on MetaTrader 4. I usually use 15 minutes, 1 hour. That is what I usually use. So we have some candlestick types. Each candlestick differ from another depending on the size of the body and the size of the wick. This is what we call a wick, the black string on a candlestick. That black line popping from a candlestick is called a wick. So we have a doji, a hammer, morning star and evening star, railroad tracks and a cord of wood. I'm going to explain more on candlesticks later in the course, because you have to know which candlestick is the right candlestick for you to enter. A candlestick does not matter unless it is seen in the right context of the market. Okay, so like I was saying, this is our doji. So a doji simply represents that price did not change within the time. This is our hammer, this is an inverted hammer, this is a morning star, okay, this is an evening star. These candlesticks, I'm going to define them, show you how they are created later. Do not worry about them, but if you manage to understand them now and put them in your head, it will be easier for you later. Okay, let me take a sip. Let me continue. So this is what we call railroad tracks. We have two equal bars of opposite colors. Cord of wood is something like this, which will be two sets of what? Of railroad tracks. So next we're going to go on trends. In trends, we have sideways trends, three types of trends: sideways trends and uptrend. So a sideways trend is something like this: the market is moving sideways. We have an uptrend where the market is gaining value, and obviously a downtrend is what? Is a decrease. Okay, so these are the types of trends that exist within the forex market. Let's go deep and define what simply each one is. So sideways trends indicates that a current movement is range bound between levels of what? Support and resistance. So support is the lower level of the range and resistance is the upper level of the range. It usually occurs when the market does not have a sense of direction and ends up in consolidation most of the time in this range only. There's nothing like the market does not have a sense of direction. Simply, what it simply means when the market is sideways is that the dealer is collecting contracts. I'll tell you more about that. Okay, so let's see an example of a sideways market. As you can see, this price stayed within this resistance level and the support level. So resistance is seen at the high and support at the low. So think of something like this. In this room where I am in, the resistance is going to be the ceiling and the support is going to be the floor. So if I was a jumper and I could jump very high, the only level that I could get up to will be the ceiling, which is the resistance level. When I'm going to drop from the ceiling, the lowest level that I'm going to go to is the floor, which is going to offer me support side that I want continue to fall. Resistance offers me resistance to go higher, pushes me down. Support holds me from dropping. Okay, So we also have an uptrend. An uptrend signifies that the market is heading in an upward direction, creating a bullish market. So this is an example of an uptrend. It indicates the price rallies often with the intermediate periods of consolidation or movement, small downward move against the major prevailing trend. So in an uptrend, it's not an uptrend is something straight like this. No, you're going to have what? Pullbacks. Price is going to pull back and come back. Okay, price will not move in a straight line. It will need to pull back. Okay, so in an uptrend we need to be cautious on taking short positions. It's much wiser to buy when price is increasing than sell, although there will be conditions where we are going to talk when to sell in an uptrend. It will be easier as long as you understand what I will be talking about and what I will be saying. So this is our uptrend from this low in here. Price hit what? This is the low. Price increased, pullback. Okay, ranged in here. So this will be what you call a range market increase. Okay, consolidate. Okay, so in an uptrend you see higher highs. The high is higher than the previous high and the low is higher than the previous low. So you see this low is higher than the previous low and this low is higher than the previous low. This is what is an uptrend and what you can say in an uptrend and expect. So in an uptrend you can buy in here, you sell in here, you buy in here, you sell in here, you buy in here, you sell in here, considering everything that we are going to talk about in the next 4 days is present. Okay, so a downtrend is an opposite of an uptrend. A downward trend in the forex market is characterized by a price decline in the current pair, okay, with slight upward swing for a period of consolidation against the prevailing trend. Okay, so like I said, a downtrend is not a straight line like this. It's something with pullbacks. Price will retrace. This is what we call a retracement. Price retraces, okay, comes back up, then continues down. Price will retrace. So in a downtrend you need to avoid long positions. It's much wiser to sell in a downtrend than to buy. Although you can buy in a downtrend, especially at the end of the trend in here, when the trend is going to end and an uptrend is going to start. That is only when you need to buy. Okay, so this is our slide on our downtrend. You can see that we have lower highs. The next high is lower than the previous high. This is our high. The next high is what? Is low. And we also have lower lows. The low is what? Is lower than the previous low. So this is on the downtrend. Okay, so we've come to the end of the slideshow on the beginning and basics of forex trading. So if you did not understand anything, okay, when you are watching this video, please make sure to jot down everything that you did not understand. Send me a question on my email or my phone number, so that I can help you maybe understand it more. Maybe I did not explain it clearly. I'm human, it happens. But if you tell me that you did not understand it, I will try to explain it in a much easier, simpler way that anyone can get it. Okay, like recently I'd been teaching my younger brother who is in grade 4 how to trade. The guy is getting it. I'm only teaching him some easy concept which I can grasp, so that everything will be okay for him as he progresses with his career. Okay, so thank you guys for watching. Let me take a rest. I had a long night. Okay, see you in the next video.